Here is the most interesting tension in this entire comparison. The account that currently pays the best yield on your cash has no debit card and cannot replace your checking account. Meanwhile, the account with the best full-featured everyday banking experience does not pay the best yield. And the third account has Zelle, but lags on rate by enough that it matters if you're keeping any real money in it. Those are the trade-offs in this comparison. And once you understand them, the question of which account is right for your situation gets pretty clear pretty fast.
Welcome to your Money on Easy mode with Damien.
Today I'm running Fidelity, Schwab, and Vanguard's cash management accounts side by side across everything that matters when you're trying to pick one: yield and how it's set, FDIC protection and where the fine print lives, access, integration, and the stuff that sounds great in marketing but has a catch in practice. If you need the full background on what cash management accounts are and why they beat a traditional bank account, episodes 32 and 34 have that covered. This episode picks up where those leave off. Hopefully, I've already made the case for switching. The question now is which one you should actually switch to, or whether you should switch from the one you're already on. Now, before we get into it, this is not personal financial advice. I am not your financial advisor. I'm just laying out how these accounts work so you can make a smarter call for your own situation. And also, I use the Fidelity Cash Management account as my primary account. I went deep on that decision in episode 17. So I have a real personal experience and opinion, and you'll hear both throughout this episode. That said, this will be a fair comparison. Where Schwab or Vanguard wins, I'll say so directly, and on at least two clear dimensions, they do. All three of these accounts beat a big bank savings rate, but the gap between the best and worst option here is not small. Here's the yield breakdown, the gotchas, and what the numbers mean in practice. We're looking at Fidelity, Schwab, and Vanguard on yield, what your uninvested cash earns, how that rate is determined, and what the fine print is on each. Let's start with Schwab because it's the most straightforward and the most disappointing. The Schwab Bank High Yield Investor Checking currently pays 0.25% APY. On $10,000, that's $25 per year. Now, better than the national average for checking, but not competitive with what's available elsewhere in this same category. The reason the number is low is structural. Schwab earns a meaningful portion of its revenue by sweeping customer cash into its bank at low rates and earning the spread between what it pays you and what it earns on your money. That practice is disclosed, it's not a scandal, but it explains why this rate is low and likely to stay low regardless of what the broader rate environment does. If you park serious cash in Schwab's checking account over time, you are effectively subsidizing their operations. So know that going in. Now, Fidelity is more interesting and requires more attention to get right. Your Fidelity cash management account holds cash in what's called a core position, and you have a choice between two options that produce meaningfully different results. Option one is the FDIC insured deposit sweep program. As of April 2026, this pays around 1.82% APY. That's real money compared to Schwab's checking rate or a big bank savings account, but it's not the headline that most people associate with Fidelity's cash yield, which is option two, is SPACs, the Fidelity Government Money Market Fund, currently yielding around 3.27% on a 7-day annualized basis. That is competitive with the best high-yield savings accounts on the market right now. Here is the gotcha, and it's a real one. SPACs is not a bank deposit. It's an investment product backed by short-term U.S. government securities. That makes it extremely stable, but it is not FDIC insured. The coverage mechanism is different, and most people don't know which option their account is actually set to. If you opened your Fidelity CMA and never changed anything, your core position is probably on the lower yielding FDIC sweep. Before you do anything else after this episode, go check which core position your Fidelity CMA is set to. That single check could be worth more than a full percentage point of yield per year on whatever you're holding there. Next up, Vanguard takes yet a different approach. The Vanguard Cash Plus account sweeps your cash into a network of FDIC-insured partner banks automatically. No choice required. The current base rate is 3.10%, with a temporary 0.25% promotional boost running through September 30th, 2026, bringing the total to 3.35%. That is the highest yield in this comparison right now. It beats Fidelity's FDI sweep by more than a full point, and it beats Schwab's checking rate by more than 3 full points. But the honest caveat, that boost will expire. The base rate of 3.10% is still strong, but if you're doing the math on what this account earns over a full year, the boosted period only runs through September. After that, recheck the rate and don't assume that it holds. So the yield winner right now is Vanguard at 3.35% with FDIC coverage, no setup required. Fidelity is close if you've chosen SPACs and understand you're not in an FDIC-insured product. Schwab is last, and that's unlikely to change. If you have a Fidelity CMA, open the app right now and check your core position. It's in the account settings. If it says FDIC sweep and you've never changed it, you may be earning 1.82% instead of over 3%. That's a fixable problem, and it takes about 90 seconds. FDIC coverage at these 3 accounts is not the same thing. The headline numbers look fine for most people, but the fine print matters if you keep a serious amount of cash in one place. So here's what's actually different. Quick version of what you need to know. FDIC insures bank deposits up to $250,000 per depositor per insured bank if that bank fails. SIPC protects brokerage customers if the brokerage firm fails and your assets go missing, up to $500,000 in securities with up to $250,000 in cash. They are not interchangeable. The accounts in this comparison use both differently. Schwab first is the cleanest story. Schwab Bank is an FDIC-insured bank. The high-yield investor checking account gives you $250,000 of FDIC coverage, exactly the same as a Chase or Wells Fargo account. No configuration, no complexity. If your cash balance is under $250,000, coverage is a non-issue here. Fidelity is where it gets interesting. If your core position is the FDIC insured deposit sweep, your cash is distributed across a network of program banks, each one covered up to the $250,000 FDIC limit. So total coverage through the sweep network can reach up to $5 million. That is well beyond what most people need, but it's a real advantage for anyone parking a large cash position temporarily. If your core position is SPACs, the coverage story changes. SPACs is covered by SIPC, not FDIC. SIPC kicks in if Fidelity as a brokerage fails and your assets disappear. It does not protect against the money market fund losing value. Now, SPACs has never broken the buck, meaning it's never dropped below $1 per share, and it holds short-term U.S. government securities, which is about as close to risk-free as investments can get. For the vast majority of listeners, this distinction is theoretical. But you should know which protection mechanism you're relying on, especially if you're holding a large cash balance and have chosen SPACs for the yield. Vanguard's Cash Plus account uses a bank sweep to multiple FDIC-insured partner banks, giving individual accounts up to $1.25 million in FDIC coverage and joint accounts up to $2.5 million. That is built in automatically with no decision required on your part. For most people keeping a few months of expenses in their CMA, all 3 accounts provide adequate coverage. The differences become meaningful in 2 specific situations. If you're holding more than $250,000 in cash, or you're at Fidelity and you're on SPACs, where the protection mechanism is SIPC rather than FDIC. Neither situation is dangerous, but both are worth being aware of. If you have a large cash position in any of these accounts, look up the specific coverage page for your account. For Fidelity, that's under your account settings in the core position section. For Vanguard, it's in the Cash Plus FAQ. And for Schwab, it's a standard FDIC bank account, nothing to configure. Now, before I compare ATM access, Zelle, and direct deposit between these three accounts, there's something about one of them you need to know first, because if this one thing eliminates it for your situation, then nothing else I say about it matters. Vanguard Cash Plus has no debit card, no ATM card, no check writing. You cannot walk up to an ATM and pull out cash using this account. You cannot swipe it at a gas station or grocery store. It does not exist as a physical card in your wallet. And this is not a temporary limitation or a feature that's coming. This is the account as designed. Vanguard built Cash Plus as an interest-bearing cash reserve account that you can access via electronic transfer. It does ACH transfers, mobile check deposit, and bill pay via routing and account number, and that's it. So if you are looking for a single account that replaces your everyday checking account, Vanguard Cash Plus is not that account, period. That said, there's a real use case for it, which I'll get into in the Cash Home Score section. For right now, just know that if access is a significant factor for you, Vanguard is off the table, and we're comparing Fidelity and Schwab. On to those two. Fidelity. Full debit card, no annual fee, no foreign transaction fee. Works at any ATM showing Visa, Plus, or Star logos worldwide. All ATM fees are reimbursed automatically, credited the same day the fee is charged. No cap, no limit, no form to fill out. Domestic, international, airports, gas stations, it all comes back the same day. Direct deposit works, mobile check deposit works. Bill pay is in the app. Check writing is available. The one missing piece for some people, Fidelity does not support Zelle natively. The standalone Zelle app shut down in early 2025, which killed the old workaround of linking your Fidelity debit card to the separate Zelle app. Your peer-to-peer options are Venmo, PayPal, and Apple Pay. And for most people, that is completely adequate. But if Zelle is baked into your financial workflow, then that gap is real. Schwab, also full debit card, also unlimited worldwide ATM fee reimbursements. The one difference is timing. Schwab credits reimbursements at the end of the month. Fidelity does it the same day. In practice, for most people, this does not matter. You're not waiting on a reimbursement to pay your rent. The money comes back either way. So where Schwab wins over Fidelity, it natively supports Zelle, directly integrated in the mobile app, no workaround required. If Zelle matters to you, then Schwab wins this section. Direct deposit is available with funds accessible up to 2 days early. Online bill pay is included. Check writing is available. So if you rely on Zelle, then Schwab is your account. If Zelle is not part of your regular workflow and you want same-day ATM reimbursement globally, Fidelity is the stronger pick. And if you're keeping a cash reserve you never actually need to pull from a machine, Vanguard is back on the table, but only in that configuration. The feature list tells you what an account can do. Your daily experience tells you whether it actually works for your life. So here's what these three platforms feel like when you're using them. This section is about app quality, investment integration, and day-to-day texture of using these accounts alongside your broader financial life. Fidelity's app has improved meaningfully over the last 2 to 3 years. It's not perfect, no brokerage app is, but it's clean, navigable, and reliable. What makes the experience genuinely useful is that your CMA and your brokerage account sit side by side in the same login, same dashboard, same interface, one place. The integration is the real thing. When my paycheck lands in my CMA, I can move a portion to my brokerage account in about 30 seconds without leaving the app. No external transfer, no waiting for ACH settlement, no logging into a separate platform. When I want to fund a trade or move money into my IRA, I'm doing it in the same interface that I use to pay my bills. Now that friction reduction sounds minor, but it actually changes how often you engage with your money intentionally. I notice it most during my monthly money review. Everything's visible in one place, which makes the review faster and more complete. More on Fidelity, no account minimums, no monthly fees, and if you're already a Fidelity investor, this is an extension of something you already use, not a new relationship. Schwab's app is also mature and well built. The experience is clean, Zelle integration works well, and the checking account and brokerage share the same login with fast internal transfers. If you're already a Schwab investor, the same one login argument applies. No minimums and no monthly fees. But here's the thing I'd want any Schwab user to sit with for a second. The low checking yield is not an oversight. It's how Schwab built the business model. They earn the spread between what they pay you on swept cash and what they earn by deploying or loaning out that cash. This is disclosed, but if you have a significant cash balance sitting in your Schwab checking account, you are in a literal sense the product for that part of their revenue. Whether that bothers you is your call, but make it a conscious one. Vanguard's digital experience is the weakest of the three, and that's been a consistent piece of feedback about the platform for years. The app works, it does what it needs to. Mobile check deposit works, ACH transfers work, bill pay via routing number works, but it's not as polished as Fidelity or Schwab, and it has fewer features to navigate because the account itself is simpler. That simplicity can be a feature depending on who you are. There is less to configure and fewer decisions to make. The account just earns yield and stays out of your way. So for existing Vanguard investors, Cash Plus fits cleanly into the platform you're already on. Your cash and your index funds are in the same login. That visibility has real value. But if you're coming to Vanguard specifically to open Cash Plus without an existing relationship, be honest with yourself about whether you want to live in that app versus Fidelity's or Schwab's. So open whatever brokerage app you use most right now and see if a cash management account is already available within your existing login. For Fidelity, Schwab, and Vanguard, it is. If you're already a customer at any of these three, you're one account addition away from consolidating your cash and your investments into one place. Here is the framework for making the decision, including what to do if you're already on one of these accounts and wondering whether you should switch. We've covered yield, protection, access, and daily experience. Now let's put it together into something you can use to pick an account. The Cash Home Score has 4 categories: yield, access, integration, and simplicity. For each category, give it a weight from 1 to 3 based on how much it matters for how you actually live with money. 1 means that it barely registers. 3 means it's a deal breaker if an account fails there. Then look at which account wins the categories you weighted highest. Let me run through who wins each category clearly. Yield. Vanguard wins right now at 3.35% with full FDIC coverage through September, base rate 3.10 after that. Fidelity is right there if you're using SPACs and you're okay with SIPC coverage rather than FDIC. And Schwab is last by design. Access. Fidelity and Schwab are tied if Zelle doesn't matter for you. Schwab wins if Zelle is important. Vanguard does not compete in this category. Integration. This one is mostly determined by where you already invest. Fidelity for Fidelity investors, Schwab for Schwab investors, and Vanguard for Vanguard investors. If you're starting fresh with no existing relationship, then, in my opinion, Fidelity's overall platform depth and app quality give it a slight edge. Next, simplicity. Vanguard wins here in a specific way. There's nothing to configure. You don't have to choose between SPACs and the FDIC sweep. You don't think about it. The account earns yield and you move on. Fidelity requires you to choose your core position and understand what that choice means, which is worth doing, but it adds a step. Schwab is simple to use, but the yield gap means that not paying attention is costing you over time. Now let me give you 3 concrete profiles based on who each account is built for. If you're a Vanguard investor who keeps several months of expenses parked in cash between IRA contributions and dollar cost averaging cycles, you don't need a debit card on that money and you want it earning a competitive rate with FDIC coverage automatically applied, then Vanguard Cash Plus is the clean answer. High yield, strong coverage, nothing to configure, fits into the platform you're already using. Next up, if you freelance or run a side business, get paid irregularly, rely on Zelle to receive client payments or to pay contractors, and pull cash at job sites in different cities, then Schwab is your pick. Zelle is native, ATM reimbursements are unlimited worldwide, and direct deposit with early access fits how a regular income actually works. Now, if you want one login for everything, checking, savings, investing, IRA, taxable brokerage, HSAs, 529s, all in one interface, and you want strong yield without having to use a separate high-yield savings account at a different institution, then Fidelity is the pick. Fidelity is my pick. Set SPACs as your core position, understand what it means, and the account becomes a high-performing hub for your entire financial life. So, no surprises here. My honest overall recommendation for most people who want a single account that fully replaces their bank and connects tightly to their investments, Fidelity wins. That's the one I use. After a year of daily use, it has only made me more confident in that assessment. Schwab is the right call if Zelle is non-negotiable. Vanguard Cash Plus is excellent for its specific use case, which is a high-yield cash reserve, not a full checking account replacement. This week's homework takes about 20 minutes, and I'd love for you to do it before your next paycheck hits. Step 1, find out what you're currently earning. Log into your bank or brokerage account and look up your APY. If you have both a checking and savings account, check both. Write both numbers down. Step 2, if you're already on Fidelity, go check your core position right now. In the app, go to your CMA account settings and find where it says what your core position is. If it says FDIC sweep, you're potentially leaving over a full percentage point of yield on the table. Switching takes just a few seconds. Step 3, run the cash home score. Write down the 4 categories, weigh each one from 1 to 3. Let the account that wins your top 2 categories be your answer. If the answer is different from where you are right now, the switching process for any of these 3 accounts is about 10 to 15 minutes online. Boiling it down, here is the whole comparison in a tight summary. Vanguard Cash Plus, best yield at 3.35% through September, strongest FDIC coverage, no configuration required, but no debit card and not a checking account replacement. Fidelity CMA, best all-around account if you choose SPACs as your core position. Unlimited ATM reimbursements worldwide with same-day crediting, direct deposit, full bank features, tight investment integration, but no Zelle. Third, Schwab High Yield Investor Checking, best access if Zelle matters, unlimited ATM reimbursements worldwide once per month, early direct deposit. However, low yield by design and unlikely to change. Honestly, there's no bad choice among these 3, just the right choice for your situation, and now you have a framework to go find it. If this episode helped you think more clearly about where your cash lives and what it's earning, share it with someone who's been meaning to sort this out. That's the person this episode was made for. New episodes drop every other Sunday on Spotify, Apple Podcasts, and YouTube. If you're not subscribed yet, take a few seconds and fix that. It helps more people find the show, and it takes less time than checking your Fidelity core position. See ya!
Thanks for listening to Your Money on Easy Mode. If you enjoyed this episode, then please subscribe and share it with a friend.